Thank you so much for being on today. The subject matter today is something that we know pretty intensely. It is on multifamily real estate investing. So we're going to show you a little bit about what we're doing specifically on our own deals. So we're actually going to dig in on a real life case study so that you can see exactly what we purchased, how we did it, all the information that you want to see behind that, and we'll open it up to Q&A. And then we also are very, very lucky to have a special guest speaker. Our special guest speaker is Bryan Shaffer. He's a partner at George Smith Partners. I want to say he's been a part of 8.5 billion in loans. Bryan, did I get that correct? Is it 8.5
Yeah, that's right.
billion?
About 8.5 billion. It shows how old I am.
Yeah, right. Well, the next time you add another billion, just funnel it our way and we'll be cool with that. Okay.
Sounds good. I'll bring a check.
Okay, cool. So he's got the big checkbook, but so Bryan is actually a lender based in LA. We've worked with him to get money directly from the federal government. So we'll talk about that. So I just want to quickly do introductions, and then we're going to hop right into what you guys all care about, which is how to make a bunch of money in real estate. So I'm Jeremy. I am part of the EQV team, Equilibrium Ventures team here in Austin, Texas. We are a financial advisory firm. We do multifamily real estate investing, which you're going to learn about, portfolio management, alternative investing, all the things that Itai has talked about. And if it involves making money, we're doing it. And I want to introduce Itai Vinik, my partner. Itai, can you just say a few quick words about yourself?
Sure. So I'm Itai Vinik. I'm the co-founder here at Equilibrium Ventures. So as Jeremy said, we do money management. We also invest in real estate as one of our diversifiers and how we make money on the side as well. On the side is actually also one of our primary tools. In the past, a little bit of background, UBS. Afterwards, I launched a wealth advisory firm as well as a hedge fund that traded options, did pretty well, and now we're doing EQV. Do you want to tell them a little bit about your parking garage company that may or may not be succeeding due to COVID?
Yeah, I don't think it's succeeding right now, but that's okay. I started an app called Spot Hero out of Chicago, which helps drivers find parking online. For all of you guys that are on, if you're not speaking, could you just mute yourself real quick? Mr. Mark, that would be awesome if you could. Everybody else, thank you. Just hit the mute button right next to your name. Helpful. Yeah, so I started that business. It's done really well. Tens of millions of people use it all across the country, or did use it. Sold another company to Coinbase. But nowadays, I like real estate and I like spending time with you, Itai. So thank you.
Thank you for saying that. And
I will. And so real quick, before we get right into the multifamily real estate, we always start with an intention or a word. And for today, I'm actually asking for a power statement. Okay. So I'm going to type in a power statement into the chat, and this is where everybody has to participate. So my power word for the day is Marim. Okay. You might be asking yourself, what does Marim mean? Well, I have to give a shout out to my friend Tori, who's currently staying with me here in Austin. He got us into doing a little transcendental meditation over the weekend, and it really helped. So I want everybody, stop what you're doing, go into the chat, write some type of power statement or word about how you're feeling, and share it with everybody, because I'm not going to move forward until we get all of you participating. We have FUD and we have Fred. We have FUD and Fed. Okay. Posy vibes that had to have come from my buddy Dan Jones. Alex Green was hungry. Alex, don't worry. You can get a delivery to your door. I have an Ohm. I have ambitious, fresh start. Eddie must have lost big in some type of poker game last week. Intense, excited. These are all the great words that we need. Thank you. I know it's corny, but it is what we do to get everybody involved. The point of this whole conversation is that we want it interactive. You're all here on a Monday night. You could be spending time with your loved ones, who I'm sure don't want to spend as much time with you. So if you're going to spend time with us, make it fun, make it interactive. Okay, cool. Itai, you ready to teach everybody how to make millions?
I am ready. I don't know about you guys. Everybody ready?
Thumbs up if you're ready. All you got to do, 2 thumbs, 1 thumb. There we go. Larry, we saw it. Ruchi, that's fingers, not thumbs. I think I saw a middle finger. You're a jerk. Cat, I love the smile. Thank you. Paul, nice backwards hat. All right, let's rock it.
All right, let's share the screen. Oh, by the way,
Okay,
you need to
I'm gonna make you the
yeah.
host. Yes, I know. I should have done that before. Okay, you're now the host. Okay, how
Sounds
do you
good.
feel?
I feel great.
Great.
All right, let's do our little take on real estate.
It's multifamily real estate, Itai. There's just
I apologize.
those
Multifamily real estate, and
real
you
estate.
can see the little home improvement nuance then on the deck presentation. Just so
Yeah,
everybody.
those hardwood floors added what, 10% to the gross rents of this building?
Yeah, I'm not the most creative kind of person, but I was proud of myself about that one. All right, so why invest in rental stock to begin with? Rental stock, or in this case, just rental units, right? There are a few reasons. We'll go into the macro reasons why now is a good time to own it. There's been a growing trend of falling home ownership in the country. There's a preference for rent for a few reasons. I'm not going to go too deep into it, but there's also a significant factor that fewer people today just have less of the ability to own homes. And we touched on that in previous conversations, why that is, so-called quantitative easing programs and other kind of things that make that more unaffordable for some people. Millennials and boomers as well, they like having no maintenance or lower maintenance in general. The renter population keeps growing versus the homeowner population. There's more need for affordable housing units. And this is the last point here. Lending standards have significantly tightened post the global financial crisis. It's actually much harder for people to get a loan today than it was pre-2008, 2009, and even pre-2000, based on various laws that passed. Sorry about that. Here is the homeownership trend chart, actually from the Fed website. We can see in the 90s into the mid-2000s that big growth in homeownership population. And ever since 2006, 7, that number has declined. And the big rebound we've seen in the financial markets and all these and all the real estate markets have, accumulated only this little move back up. COVID-19 is likely to make this trend shift backwards towards less home ownership. This is actually a recent Zillow economic research showing the number of adults that are currently living with their parent or their grandparent. And this is pretty staggering. So are they more likely to own homes in the future, or are they less likely to own homes in the future? Well, they're probably not doing the very best if they are living with their parent or grandparent. With that probably means that they're going to be future renters. So that increases the need for housing units even more.
Itai, did this stat give you any insight as to how many people willingly chose to go back with their parents? Like, say the people who just wanted to be closer to the kids and get some family time while they could, and how many of them were forced to go back because of financial reasons?
No, it does not. But you can look at other things for financial indications, such as amount of people with certain levels of saving. We know 78% of people have less than $1,000 saved up, which is crazy statistics, but that came out of Forbes about a year ago, and other metrics such as unemployment claims and things like that. So my suspicion is it's more likely that they were forced.
Cool.
Okay. So why we're going into the multifamily unit world? Why are we going into the world of these complexes and apartment complexes? And the main reason is single family homes are predominantly based on what we know as comparable analysis. I know there's some other people in this call that do real estate brokering and then have owned some single family units, and they can tell you how great it is to be on an appreciation wave in a city like Austin, where it's to your benefit to be valued based on the comparable analysis, because the values just keep going up around you, almost unrelated to the income that it's producing. However, if we're looking at it as a business standpoint, multifamily units are usually valued based on the income they're producing, just like any other business. So what this allows us is to de-risk the investment process, because we can forecast future income even 5, 6, 7 years down the road better than we can forecast the price, right? We don't know what the price is going to be in 5 or 6 years, but we can more or less forecast the income, and therefore we can figure out what the price is.
And you're saying because like, hey, it could be Austin. Austin might be hot right now, but we don't know in 7 years what the single family home comps might look like. They might be flat. They might be way through the roof, but at least we know a business that generates real profit. We know almost always how a bank is going to value that, and we can use that to our advantage.
Correct. And we'll touch into that. There's
Perfect.
another big benefit here, which is the economy of
Yeah, you
scale.
don't know necessarily what the cap rate and some other things are going to be too, though. So you can't exactly put a value on it. But.
That's 100% correct, Alan. So cap rates do fluctuate, but as far as a risk level, we feel that the risk level here is lower because even if the cap rate expands or contracts, we can still forecast what the cash flows are going to look like, and we can figure out what the coverage is versus the debt. But that's a very fair point.
Cool.
Another thing is the economies of scale is something that makes your total return look a lot better in general, right? Because at the end of the day, if you have 200 units and you can hire a few maintenance people, you're going to be okay, and all your expenses are going to more or less average out in the long run. So if you own one home and a water heater just got busted out, you could potentially be losing on 3 months worth of profit margin. But when you're owning something on a larger scale, that doesn't play into effect. Another reason that I'm going to touch very briefly, other types of commercial real estate carry significantly more risk. We see that with COVID-19, for example, where retail stores and other types of real estate are not doing nearly as well as multifamily. At the end of the day, people need a place to live. They don't necessarily need to go to a restaurant.
Yeah. Cool.
All right. So what is our strategy? What do we actually do in this real estate world? We pursue the BRRR method. So the BRRR method, plain speak, is buy, rehab, rent, refinance, and repeat. So that's a strategy that allows investors to accumulate a larger passive portfolio over time, with the idea that the money for the next project comes from a refinance versus from the actual sale. And that is what allows you to build a bigger and bigger portfolio over time. So
this is literally how you don't actually ever have to sell an asset per se. You can go to a bank and get your liquidity event and get your money back and continue to keep the asset. So this is how certain people buy and hold and get thousands and thousands of units, literally by following this method.
I beg to differ a little bit. I mean, it maybe works in the clean market, but there's a lot of places where you just can't create that kind of value quick enough to be able to do that. But it's nice if you can.
Yeah, that's fair. We're definitely going to have certain markets where that's not the case, but this is definitely one that you can use, and you can find value add opportunities where this can
well it's still the case even in other markets, but the turnaround time is different. So maybe in a Chicago market, it will take you a decade for inflation to appreciate the asset enough for you to refinance. So it's definitely true, but the question is how fast can you do it, and that varies between the markets more, I would say. So point being, once you've bought the asset, you've then revitalized the asset through some repair work or better marketing or whatever it is that your process is in doing it, you earn a bigger profit. That creates more equity in the property. You can then tap into that equity with the refinancing process and eventually buy another property and repeat the process. So we'll go and talk a little bit about all of these. So buy. I think a lot of people underestimate the buy, and they say, well, just buy. I heard real estate is really good. This deal seems this deal seems fair, and I'm just going to go into it. And I think a lot of people don't realize that you often make your money buying something right. So buying something right means that you have to do a lot of analysis, a lot of deal analysis, basically estimating your cost correctly, estimating your rental comps correctly, estimating everything correctly in order for you to have enough of a buffer zone between where you're planning on being once the property is stable and where you are today. And if you do all of these correctly, you should be able to make decent money doing this. A lot of investors use the 70% rule, and that basically estimates that what you could pay for a property is 70% of the cost of purchase plus the repair. And if you do that, that leaves you enough room for error once the property is stable. So how do we do the buy? And Jeremy can talk a little bit about that. We use an extensive off-market strategy. None of our deals so far has actually been on market.
Yeah. So, I mean, this is where everybody has to ask themselves, like, what is their core competency? I come from the startup world. So there's a lot of tools that are very interesting, like county assessor's offices, where you can get large information about all the different properties in a given area. You can take that information, you can throw it through online enrichment tools where you get contact information. And if you run the right campaigns at the right targeted properties, you can find these owners. So, I spoke to a number of people today that have $10, $15 million properties. And, there's ways to track these people down. All it takes is one of these people to say yes, and then potentially you've got a chance to make millions of dollars. So there's a little bit of sweat equity that goes into it, but at least you have a chance to, from my perspective, find your own deals versus relying on a broker that has to bring you some deal and fish it out to the whole world. So that's the approach we take.
Absolutely. So the next thing is the rehab. I think this is something that a lot of people need to take an investor mindset in realizing that you need to put the minimum amount of money that can generate you the most amount of return on your rental. And that's actually a fine line between overspending on something and just getting it right to getting that market rent. And I think that's something that could be acquired with both experience and research. And sometimes
I wanted to say, we use certain rules of thumb, like when it comes to us for asking ourselves, do we want to renovate all the interiors? We'll ask ourselves, hey, does the cost pay itself back in 2 years, right? So sometimes we'll try to figure out, do we want to add new floors, do the painting? We'll say it's $3,000, but we can only justify a $50 increase in the price of the rent. Well, $50 times 12 is $600, times 2 years is $1,200. $1,200 doesn't pay back the $3,000 cost to do it. Well, Nick's doing that, right? So you can use, there's some of these, we can send you some of like the resources to help you think of what to do a rehab on, but these are just like some of the constructs that you can use in your head to figure out if you might want to do this type of thing.
And I would say too, that in actually the experience that we're going to show you, which is our deal, the rehab could be as simple as raising rents to the market level. There could be a situation like we had where it's an owner that has owned the property for 30 years and the property was built by his father and he just hasn't kept up with market rents and hasn't raised them in 10 or 12 years. And it could literally be as simple as putting it into the market. So
well, in that case, though, we did end up putting in $15,000 to $20,000 to build a laundry room, which then allowed us to justify the increase. So It's not coming in and raising rents as it is, but we're adding some type of perceived value to the tenant that we know that they're going to pay for, and we make sure that that is going to be bringing the money back. So yeah, you can go to the next one.
Yeah, absolutely. Okay, so here's the rent. The rental part is actually some of the most tricky part, which is the leasing part, which is a science on its own. In this case, once the rehabilitation is completed, new tenants need to be found. And screening for tenants, getting the right tenants, responding to maintenance requests, and managing the whole process successfully could be a challenge. And we engage with a management company. We have weekly reviews to make sure that they're doing their work correctly. Jeremy can elaborate more into how we get tenants.
Yeah.
Before you do that, I will say too that what we were doing is when we get a larger property, it's not like we're trying to raise the rent on the entire property. We take a ladder approach where we take a fraction of that property and we strive towards stabilization over a course of a year. So we do it on a gradual basis so we don't lose too much income by trying to come in and raise the rent or do too many units at the same time.
Yeah. So Itai's right. That laddered approach of being able to turn some of the tenants over and over is a good risk mitigation strategy. And if you're just trying to figure out, like, how do I do all this type of stuff? Like all of you have jobs, you're all operators. You can get on websites like biggerpockets.com. There's a lot of literature out there about how you can do some of these things, the rental criteria that you want. You know, for us in a working market, we make sure there's no evictions and they must make 3 times the income. It definitely leads to people that don't get accepted. But once you get your rent roll locked in, that's the people who you're renting to, then you have a strong asset that can carry you forward. So, we're big proponents in getting educated, putting our sweat equity into the business, and that allows us to really do this increase in the value of the property that Itai is going to talk about.
Right. So this is I would say the most important part of it is that once the property is fully rehab and rented and it's stable and you get the higher level of income that you actually projected, you can potentially go to the lender and now access that higher value by borrowing against the higher equity value of the property. If you did it right and you were able to extract enough value based on the cap rate, which is what we're able to do, you could potentially get all your money back or potentially even more, and then you just roll it into the next property. If you have enough rental income to cover the new debt payment, then essentially you now own 2 properties and you're able to grow your portfolio without selling anything, and you can do that successfully. So here's where it comes to what I think is one of the greater secrets in the real estate world, which is the forced appreciation. So the forced appreciation means that you are the one in control of the property value. So because multifamily units, and I've said that before, I'm going to repeat that, because multifamily units are generally valued on the income approach. If you know ahead of time that area or that place you come in is low in the rent, it could already assist you in projecting what the future value is going to look like. So banks are more likely to value something based on the cap rate, and increasing something if you increase the rents and the income by 30%, you can significantly increase the property value and what it means in refinance. So Alan did mention in the past that cap rates can change, and that's one of the risks when you come to refinance, because that can change on a more cyclical basis. But even if that's the case, you have enough cash flow now that you can just wait out for the cap rate environment to change and tap into the refinance market later, which is what makes it.
Itai, two quick things. The first is we're going to actually show you the math behind this later so that you can see it all. So you will see the numbers and not just the explanation. Second thing is, if somebody's sitting here saying, what the heck is a cap rate? What is it? And why do people pay attention to it?
So that's the capitalization rate on an investment. So if you look at real estate like any investment and you assume that an investment is supposed to make you 7% a year. So if I'm buying a building for $1 million, I'm expecting to make, based on 7%, $70,000 of income per year. If that income is now $100,000 and that cap rate, basically how much you're supposed to make on that investment, stays the same, then that building is worth more. So that's the simple explanation of what that capitalization rate is.
And I've also heard cap rates talked about as somewhat of a measure of risk. If you go into a coastal market like a New York City or Los Angeles, you might see cap rates that are going to be around, the 3% world, right? Where it's presumed to be safer, you can get more money to work. Whereas in some of the markets that we're in, you might have a market where the cap rate is double that, right? So not all the same. Where you go to Detroit, you might find things that have high single digit, low double digit cap rates, but there's a bunch of problems associated, and it's a level of risk.
But that's also not 100%. I mean, that's a presumed level of risk, right? Because it is true that it is true that it's the same as with the bond market, where a junk bond is going to give you a higher yield than the treasury market, right? Mm-hmm. But at the same time, with real estate, doesn't exactly work the same way. So if you go to LA or New York and you're only getting a 3% cap rate, it also leaves you with very little room for error for your operations. So on one end, that's true. But on the other end, having too low of a cap rate actually is very risky, because it doesn't leave a lot of meat on the bone in order to do that. So that's where it differs from the bond market equivalent that you just said.
Good point. We got a few questions from the audience, which we might want to talk about. So Eddie says, does the refinance typically include personal guarantees?
It depends what kind of refinance you get. We have been able to get non-recourse government loans. So non-recourse loans do exist for stable properties. So it depends on, I guess, a multiple factor. That's probably a question that's better to ask Bryan later on.
Okay, we'll ask Bryan.
If you want me just to jump in real quick, it really just depends on the sponsor and the individual. Some people have low leverage and they're not afraid of recourse, they'll take recourse. But usually there are non-recourse options, like you said, Fannie Mae and Freddie Mac. There's also private loans that are usually non-recourse as well.
Got it. And before we keep
Thanks.
going real quick, do we want, Rob wants to know what non-recourse means.
Basically means that if you default on the loan, they can't go after you. They can go after the asset, but they can't go after any other asset or your personal credit or anything like that.
I was going to say it means you could sleep at night, but same thing.
That's true. That is true. And Alex wants to know, can you own the property inside of an LLC? Yes. All of our properties that we own are within an LLC, and we take the financing against the LLC.
Correct. So let's jump to the repeat part. So now that we've gotten our cash flow, our cash out refinance from the rental property, we can now fund the acquisition and the rehab of the second. So you can see how you can keep rolling the money, and eventually, this is literally the method you've heard of people that own 20, 30, 40,000 units. This is pretty much how they do it, because they never sell the original one, and this is the secret.
Yeah, and I literally was speaking to one of those guys today. This is exactly how he does it. So, yeah, so let's hop into it.
So let's hop into our deal. We'll give you a real life example of something that me and Jeremy did. Actually, our own money, no investors involved. And we did this in a market called Killeen, Texas, which is an hour north of Austin. So Killeen attracted us because it has the largest military base, U.S. military base in the whole world. It has significant population growth. We've seen the whole metro area get to 450,000. I think today it's around 500,000. It's going to be at about 550,000 by 2030. And Fort Hood is a massive economic anchor. Killeen's population has grown. I think here they showed actually 35.4 billion as the world's largest military installation. And that region has grown by significant double digits. And now it's growing also because it's close to Austin. So it's not only the military anymore, but it's a very interesting market because it has that strong economic anchor as far as the military base that is fairly stable. And I'll show. Oh. So right here, you can see that the US military has actually been the largest employer there since 1942. And they have recently invested in major infrastructure. The project is projected to be done this year. They're by far not only the largest military employer, but also the largest civilian employer, and creates lots and lots of derivative jobs in the area. What I found very attractive when we got into the area was the following chart, taking again from the Federal Reserve database. Average home plot prices in Killeen right there, that's the Great Recession of 2008-09. If you look at the same website for Miami or Vegas or Phoenix or many other cities, you're going to see a massive dip here. Killeen has literally seen none of it. And the reason is the military was here. It was business as usual. Another thing that makes the area a little bit unique is that the renter population is really, really high. If you think about the soldiers that come into that area, they're almost like college students. They're about the same age. But the difference is they stay for 2 or 3 years. They don't have a summer vacation, and they actually get paid. So it's almost like for us, it's almost like a better version of student housing. So I think one of the reasons is you didn't have that much homeownership to create a dip in that market. So lots of reasons to get in there. This is actually the picture of our property on Mary Street. So I think here you can see our management company coming in and introducing themselves on our first day of ownership. So we own this building right there and the one behind it. We bought it for 1.1 million cash. It was 38 units in the...
Itai, can you explain, after you're done doing this, can you explain why we purchased it in cash from the beginning?
Right, so a few reasons. First of all, we wanted the proof of concept that we're able to do it correctly. We knew that sometimes banks have a loan to cost thing associated with them, so we didn't necessarily want people to know what we bought it for. Texas has a non-disclosure on that as well. And we knew that our refi proceeds, because we got it so discounted, are going to be likely much higher than our original purchase price.
Yeah. And so when Itai talks about that, if you buy something in cash, when you go to do your refinance, the bank literally has no idea what you paid for it. So they're literally going to look at the valuation based on their own metrics, and they're going to say, all right, well, if it's worth X, we'll let you take a loan of 65% against that. We're going to show you the numbers behind that literally right after this.
Right. So yeah. So here's a 7 cap example of this property. So when we bought it, the NOI, which it's net operating income, right? So it's basically you have your gross income, and then you have property taxes, you have insurance, you have maintenance costs, you have management costs, all this kind of stuff.
Or you can just think about it as literally revenue minus expenses. Once you've paid out all your expenses, what's left over? That's your NOI.
Right. So your net operating income when we purchased the property, it's more or less $96,000 a year, which is already a pretty good deal for $1.1 million, right? It's not really a 7 cap. It's actually higher than that. But if you were valuing this as a 7 cap property, it should be worth $1.37 million. You just basically take the 96,000 price and you divide it by 0.07, which is how you get that number. Now, assume today, which is pretty much where it is, 12 months later, we're able to increase rent from 96 to 168. At a 7 cap, you take again that number by 0.07, you're at $2.4 million valuation. Now assume we take a 65% loan to value against the property that we own debt free. We put in 1.56 million back in our pocket. And then again, that's tax-free dollars because it's a loan, right? We didn't sell anything. We just took a loan. So why would we pay taxes on it? So we're able to pay ourselves our investment back and almost put, I wouldn't say $500,000, but close to $400,000 in our pocket. So now we have cash flow of still $8,000 a month after the new debt services, and we have a bunch of money to roll it into another project.
Got it. And Itai, I just want to pause and really clarify a few things, because I think this slide is the most important slide we're talking about the entire call. So one of the things is, remember, these multifamily buildings are looked at as a business, right? You know when somebody's rent is low. You can literally look at all the comps in an area. You can use a bunch of tools. So when we bought this building, we knew that the average rent was $408 a unit, which is way lower than the market. Market was probably somewhere closer to $550, right? We made money on the buy because the bank said it was worth 1.37 and we bought it for 1.1. So we made money on the purchase, but then literally just through our own sheer effort of saying, all right, we're not going to renew certain tenants. We're going to find new ones. We're going to get the building to market rent. We're going to build a laundry room. We literally were able to unlock an extra difference of $1.3 million by doing that. We invested probably, 10 hours a week for the first maybe like month or month and a half of each of our time into this. And ever since then, it's maybe a few hours a month. And now we literally have just gotten all of our money back, all of 1.1 million, put in almost 500K into our pockets, so 250K to each. And then even more incredible, we're going to get $8,000 a month going forward as just cash flow to us. So all those proceeds that we got, we are now literally going to take everything we just learned and roll it into the next property. Incredible.
Absolutely.
And the loan that we get, the interest on that loan, because we did the refinance, is actually tax-free, so we can deduct that. And then when we're using the real estate, we can take the depreciation, accelerated depreciation. We can capitalize the things that we bought. I mean, we're not going to pay income on this. We're not going to pay taxes on this property for what, 5 to 10 years?
I don't know if that long, but we will definitely not pay a lot. We would be in a much lower tax bracket than regular normal income.
So we have one good question so far. Larry says, did you do the first hour rehab? Why is the cost not in the equation? Do you want to speak to that?
Yeah. So I hate to say it, but it cost us $15,000 to $20,000. We only put in a new laundry room, and we just raised the rents because the rents were just so under market, which I can show right there. When we purchased this is the slide that we use Rentometer to show us the rent in the area. The average, I think we have 22 2-beds and the rest are 1-beds. So the average 2-bed in the area was trading, I wouldn't say trading, actually renting at $600 a 2-bed, and the 1-bed was at $499. We were averaging the whole property at $408. And this property is not worse than the others. These are equivalent properties. Not only that, we noticed the other ones didn't have laundry rooms. Also, the area is relatively short on higher quality buildings in general. So we know those comps were more or less correct. So that's simply what we did. We did nothing too crazy, but we didn't do any extensive rehab, which is why in this case, we don't have the cost of rehab in the equation.
Yeah. And this is not how all of them are going to be. Some of the ones we've done since definitely have a rehab budget, but it's just so you can get a sense.
We found another fairly large one that is the same situation. And we are able to get the rents up by 30% also without doing anything. It's not the only one we found this way.
It's not the only one. We found an inefficient market, which definitely helps. Itai, I want to pause real quick because we're definitely getting a bunch of questions in. So the first question is, David, you want to actually ask it to everybody?
Sure. What was the turnover like when you raised the rents?
Good question. So the first 30% or so just left, and we had to find totally new tenants. But the other 2/3 ended up staying.
And we thought it was going to be, I thought it was going to be a turnover rate. I thought we were going to maybe keep 1/3 of the tenants, but we did a few things right. We built them a laundry room, which cost $20,000, and we signaled it to them. They all knew that they were under market. And one of the smartest things we did, and if you're going to play in this world, I highly suggest, we did not do any of these gradual increases to the market rent. And I think this is really one of the most powerful concepts to understand is you need to go through that pain and just do it. So if they're $408 a door and the market rent is at $550, bring it to the $550 right away, because the tenant that is going to, pay you maybe the increase to $450 will likely not be your tenant at $550. In this case, it actually turned out everybody knew that they were well under market. And because we did a good job, most of them ended up staying. But I can say unequivocally, going right to the market rent when you turn them over was the smartest thing we did.
And let me emphasize something else here too. You're only able to do that obviously in a landlord friendly state, right? You're not going to be able to raise rents by 30% overnight in a place like California or New York, right? So we're playing in a specific market that is catered to doing something like this.
Yeah, but these people who are sitting in California, New York, and Chicago, like, go get on a plane. You don't have to do everything in your own state, right? I mean, it obviously helps for a first deal, but there's a lot of opportunity around there. And, part of it is getting out there and, seeing what else is there.
Right.
And we got a lot of other questions, Itai. So is this affordable housing? Is this a mix of private and Section 8? Eddie asked.
There are no Section 8 at all. This is all normal rental. Just that market just has relatively lower rents to what you guys are used to seeing on the coast and in other large metros. Yeah. The average rents here are $550 to $700.
And what was the cost of the turnovers or the rehabs once tenants left? Because we did have to remake some of those units entirely.
We've only remade about 3 units, and each time we did it for $2,000 to $3,000.
And that's when those were situations where we might have had a hoarder and the whole place was screwed, and you had to really do everything from the beginning.
Right. And let me let's pause later for more questions because we do have some more stuff to get through.
Yeah.
So I do want to say one of the things that enable us to unlock this income was actually not only raising the rents, but also running the expenses more efficiently. When we purchased this property, the expense ratio was sitting around 60%. There was just a lot of inefficient spending. We projected that we'll be at about 38.46%. We came within about 2 percentage points of that once we stabilized the property. And you can actually see that that's on par with apartment buildings in general. And what I found very interesting is maybe this has to do with cap rate suppression, but the cost of operating an older property is not that significantly higher than a newer property over time. It was much greater 10 or 12 years ago. So I'm not exactly sure why that's the case, but it seems like today, there's some kind of edge to be unlocked with buying an older property and just running it correctly, because you will pay a lot of a premium for newer units.
Got Cool.
This is if anybody's interested, this is the demographics of the zip code that we bought in. We knew we're buying into an area with pretty heavy young population, which is something you don't see everywhere, partly because of the military base and a lot of people stay in the area. And the average income is not bad for a family. It's actually greater than the US median. For an area of such low rents and low cost of ownership, we thought it was pretty compelling to make sure that people actually do pay their rent. And so far, for example, during COVID, we've had 100% collection. So we just know that when they're making enough money and their rent is not relatively that high, we shouldn't have too much of an issue. So we currently have stabilized the property. The rents are exactly where we projected them to be in 2019. The expense ratios are within 2%. The tenant mix has drastically improved. The laundry room has been built. The value at 7 cap is 2.2 to 2.3. Could be as high as 2.4. We'll see. And we're setting ourselves up for refinance in the next few months, and potentially package that refinance with another property that we're doing 10 miles away with. That one actually included some heavy rehab, but that's not the example we gave today. So
yeah,
that's it.
That's it. Itai, do we have any time to go through just some of the quick questions that came through?
Sure, just a few quick questions, but then we have to turn it over to Bryan.
Yeah, it sounds fine. So Mike, do you want to ask your question about the seller liquidity?
Yeah. So, sorry, I was getting off mute. So how did the deal structure come to play when you all were negotiating with the seller, and what led them to wanting liquidity? And how did you all kind of position the deal with the off-market seller?
So the reason that the seller was selling is that he had this as part of, was it a trust? Itai, or was like some type of like.
So he's an older guy. The place was built by his dad, and his dad died a while ago, and it was held in some kind of weird trust between him and his sister, and they just didn't want to work together. So they were willing to sell it at a low price just to get rid of it and just dissolve their partnership. They were very unsophisticated. I mean, the guy was in his 80s, and again, he did everything on paper. He didn't even have a computer in his office, and they haven't raised rents in 12 years.
Yeah, and he was also very foolish. He, instead of getting a broker to actually help him buy it, he used what's called a wholesaler, which is a much less sophisticated person in there who tries to get another buyer. And so we had a really big shit show of a time dealing between the three different parties, but it was basically for his inefficiencies, that we were able to get this deal at such a killer value.
Thanks. Good job, guys.
And Rob, before we turn this over to Bryan, it seems like you've had some questions flowing through. Is there anything, anyone that you wanted to ask?
Well, yeah, I took a picture of y'all's next property. I put it up behind me here. So
is that
and y'all were, I saw this one y'all had, I think, was starter project. The question is this. So what's your percentage of renters? Obviously, y'all have done good in selecting your tenants. So if you have like 80% rent tenants in there, is that like your break even? What's your break even point for that? And because of the success of this, you're in Killeen, so you might be heading towards Temple or Waco. Has a lot of growth also. Are you has this kind of biased you though towards like military cities just because of the unique factor that people have a steady paycheck also in this?
Well, let's just make it clear. The fact that it's a steady paycheck into a military city doesn't mean it doesn't have any risk, right? Because we've basically converted the economic risk of a recession with a deployment risk. So our risk is actually political. So we do carry some political risk, and we did see vacancy go to 15 to even 20% in 1991 in that area with the Iraq War. So even though that's the case, it's not risk-free. However, let me emphasize that, right? We can easily absorb 15% vacancy and still survive. Our break-even rates are actually around 70% occupied, just because, we're buying it right with a rich cap rate. So I've asked a question. Yeah, sorry.
I was just gonna say, the other thing you mentioned a couple of weeks ago is you looked at like water projects for the state and the counties to look at for possible properties, I guess, where they're building sewage and drainage and that type of stuff.
That's true. And you'd be surprised the level of growth Killeen has actually seen. So it's a number of factors. Growth is a part of it. How much income we're getting is another part of it. But I suspect that if there was another massive deployment, Colleen is probably not going to see the same level of vacancy as we've seen in the past, just because we're getting a lot of Austin derivative coming in there right now.
Cool. Awesome. Okay. All right, everybody. Want to say thank you for holding in there. I really want to turn this over to Bryan. Bryan is our lender. He got us money directly from the federal government. He's a great guy. I'm going to give him shit about all of his Peloton stuff that he's got in the background. It's just because I'm jealous and they're shutting down all my amenities here in Texas. So, Bryan, I got to get myself a Peloton. Anyways, want to turn it over to you. Walk us through everything, and thanks for your patience.
Well, thank you guys for buying me this great equipment. I really appreciate it. I'm going to try.
You still owe us a lunch or dinner, okay, when we get to LA.
Yeah, someday.
Someday.
Hope it's over. So do I need to do something to start sharing the screen too? And
yeah, you can hit the bottom, the green button at the bottom. I just made it that you can share your screen as well right now.
Okay, cool. So thank you, everybody. I'm Bryan Shaffer. It's great meeting everybody over Zoom. It's such a great tool that hit share. It's such a great tool for everybody to see what's going on and to connect when we're limited in our ability to connect.
Absolutely.
So can everybody see? Oh, we do.
Yeah. Right now we see the
Yeah. So if you want to go to the bottom right where you have the little yeah.
Hey.
I'm making progress. So again, I'm Bryan Shaffer. My bio's online. I've been doing this for 30 years. It's great to meet everybody. What I wanted to do is start off with explaining a little bit. And it's funny, as we were on the call, I had this list of properties that I've refinanced in the last year. And I started thinking about which ones are BRRRR. And as I went through them, all but two I've financed several times, and the owners have they did a rehab and fixed it up, and they got higher rents and did another rehab, pulled more money out. So all of these sort of follow that example. The one right here, the $12 million SRO in LA, I originally financed that at $3.5 million, and they've now got up to $12 million. That was like 8 years ago. So they pulled a lot of money out of that property. These two that weren't BRRRR properties are actually ground up development. The $43 million, Costco Center and the $12.8 million condos were ground up development. But every other owner is basically buying and rehabbing. So I never really thought of it that way until this call. But as I looked at it, they all sort of fit that model.
Hey, Bryan.
Yeah.
There we go. Now I see the different. I think you might be one slide behind.
Right now. Yeah, okay, it shows me this slide and next slide. I apologize. Okay, now I see what I did. So again, I'll show you real quick. So this is the 12.1 million and then the two development projects. But out of all of these, they've all been projects where the owners bought them a while ago and has just done something, refinanced, done something again and refinanced. And even the like the medical office building, it started off as a single property that wasn't in that good a condition, and they improved it and built it out for a medical hospital user. So they increased the value tremendously. But there is something to be said for buying and holding, because it really is the way that people make money. I'm with George Smith Partners. We do about $3 billion a year in financing. We have 65 people. I'm one of the 8 partners of the firm. What we basically do is get capital from all sorts of sources based on the project. Somebody mentioned earlier on the call, recourse versus non-recourse. Everybody's looking for something different. Some very wealthy guys want to own properties. They don't care about recourse because they believe no matter what happens, I've got enough money, I'm going to hang on to these properties, so I don't care about recourse. Other people have, $5 million net worth and are buying $50 million properties, and being responsible for that one property, if it blows up, could destroy their whole life. And so they want non-recourse loans. So we have the ability to do all sorts of financing and really tailor it to whatever our client needs. In this case, we've done a lot of Fannie Mae and Freddie Mac with Jeremy and Equi. It just made a lot of sense. We use all different sources of capital.
I think you went back.
Sorry. Yeah, I'm on the next. Did I go the wrong way again?
You're going backwards, taking us back to the beginning.
I apologize for my age in advance. So this is our process. We do everything from the beginning to the end, make sure we get through the loan process with Fannie and Freddie. It's a 60 to 90-day process. They want lots of information, and we make it so Jeremy and Itai aren't every day of their life talking to a lender and trying to get them one more document. We try and organize it and get it to them. Basically, I always look at the multifamily real estate market there's different lenses that people look through it. Like Jeremy and Itai are going to look at it one way. I'm going to look at it a different way. A lender is going to look at it a completely different way. One of the most important things I think on real estate is cash flow. And I was telling Jeremy and Itai earlier that I really looked at cash flow as pigs and cows, because a cow you can milk. So if you have a cow, you can continue to give yourself milk over a long period of time. And a pig, you're going to probably slaughter and have a great bacon and pork dinner, but you're going to have one huge feast and then you're going to be out. And that's sort of, I look at development projects, and as we looked at my list earlier, there were 2 projects that were ground up development. Those were definitely pigs. Those guys took a lot of risk, and if the market had been in a certain place when it finished, they would have had a lot of problems. Where with cows, you could sustain those markets, as Jeremy and Itai were talking about earlier, where, if the cap rates change, you just hold another couple of years and likely the cap rates are going to go back the other direction. That's what we see over like a 10 to 15 year cycle period. You'll see cap rates creep up, creep down, creep up, creep down, but they're staying pretty normal. And the other benefit that Jeremy and Itai have is the market they've picked isn't as volatile. So when you go to LA or Chicago or New York, you have these big jumps in cap rates where they go down to 3 or 4%. And then when the market's not as good, they go to 5 or 6%. But in the case of Colleen, it's stayed pretty consistent, and they haven't had a huge influx of borrowers or buyers coming into the market to drive cap rates down. Again, as you look at the field, the pig is the opportunistic deal that has a huge profit at the end, but it has a ton of risk. It's the one where you really don't sleep at night, as one of the people said on the call, where value add properties and permanent financing is much more stable and where you could sleep at night. And something I want to add to what Jeremy and Itai did, and I really think it's neat, is that the properties they're buying pretty much are stabilized when they buy them. They just have low rents. So they're stabilized at, say, an NOI of $300,000. And they've looked at it and said, we can make that NOI $400,000 or $500,000 in the future, but it's stable today. It's not a zero NOI. So if they want to finance it going in, they can take out a loan. On one of the deals we did a really short prepayment where they can prepay, pretty much right away. It was like a 2-1-0 prepay, which means, the first year they could pay 2%, second year 1%, and then after that it's 0 for the other 10 years or 7 years of the loan. So what it basically did is let them get cheap financing day one, with the idea is if they bring that NOI up, they'll be able to refinance it and pull cash out in the future. And so I think it's really important. And I think, again, it's something that's sort of unique. You can't do this in every market, but it is interesting in Colleen that you could buy pretty much a stabilized property that's, 90% occupied, but just everybody's paying too much or too low of rent.
I liked your 3 cows in a row. That was the finest skills of copy and paste I've seen in quite a while.
No, and the ones I circled, I did while we were on the call today. The earlier slides, you should be proud of me. I'm really getting good at this.
I did notice that too.
So one of the things that I think is most important, and I think it fits into what somebody said on the call today, is that cap rates can move. And if we look at the history and we look at recessionary cycles, those cycles occurred when there was not enough capital. In 1991 to 1994, I graduated college in 88, and in 90, I went to work for the RTC, the Resolution Trust Corporation, which was, basically what the FDIC is today. It was a group of the federal government that took away properties and did distressed debt for the government. And what I learned is that the difference between 1990, 91, 92, 93, 94, Then other cycles is there weren't a lot of lenders, there wasn't a lot of capital available in the market. And so those periods where there's not that much capital wipes people out. So if you have a good plan, if you're doing cash flow properties, if you're milking that cow, you'll survive those cycles. If you're doing pigs where there's a huge development part of the equation, you have a completely empty building or you're doing ground up construction and you get caught in one of those cycles, you'll get wiped out by that cycle. So really having a good plan is really important. And I sort of talk about it here again that, cash is holding power, having flexibility in your debt, like Jeremy and Itai did with the loan. They could have done a really short bridge loan, but in a year they would have had a gun at their head, where by doing the longer loan with the really short prepay, they have the ability to refinance, next year, or if they want to pay the fees even this year. But at the same time, they have that stability where if they got caught in a cycle, they can make it through that cycle. And I've always believed that the best developers, the best sponsors have good business plans and think this through. There's a lot of people out there that inherit properties or just buy something randomly and don't really have a plan on how they're going to get out. And I really appreciate, owners and investors that understand that.
Bryan, real quick question for you. The one thing you talked to me earlier too that really just kind of resonated is you talked about how to be the best people, like they will not lose their properties. Can you just help understand, like, why do people lose a property? The ones who are not doing things correctly, and why is it it makes so much sense, but why is it such an impactful, important thing to not lose the property?
Yeah, and really, if you think about it, and it's funny, maybe the best example, there's a lender that I deal with, and they've been around for 35 years and they've never lost money on any properties that they've had, which is pretty incredible for a lender. But their secret is it's holding power. So if, cap rates go up, if values change, they have that ability just to stay on the property. They don't over leverage themselves. They don't put too much stress on themselves. And so they're able to sustain those periods where I have clients out there that own $100 million of real estate and have no cash whatsoever. They've constantly done, sort of the BRRRR method, but they've
Overextended.
They've overextended it, and they haven't really planned out and said, this is the ideal level for this property. Instead, they've maximized it out as much as they possibly can. And in some periods of time, like I have a bunch of guys in 2012 and 13 that did that, and it made a lot of sense because the market had declined back, 30% from where it was clearly going back up again. People were buying at very low bases. So that was a time maybe to take that additional risk. But as a general rule, you should have a plan where you see those values and you say, this is good enough. Pulling $1 million out of this property is good enough. I don't need to pull $2 million out, but then if there's some slight change in the market, I'm going to get hurt. And it really is that holding power, because the more debt you take on, the more you increase your net worth. But if you don't have cash and emergency or some emergency funding, you can get caught in that cycle. So it's really just planning and looking at it and saying, what's the worst case and the best case? And I want to make sure I want the best case, but I want to be prepared for the worst case.
And I think the debt coverage ratio plays into that quite a bit. So when we do it with our underwriting, right? So we're basically saying,
definitely.
If I know my gross income is 2.5 times the debt servicing, then I'm probably going to be fine.
Yeah, you're in very good shape. And there are, what happens is, like, as we get into, debt funds, more structured finance, you can really find guys out there that will let you go to, like, you could do mezzanine debt to 105 debt coverage. So you have just so that they understand, a debt coverage ratio is you take your mortgage payment and you divide it by your NOI. So what you're really trying to do is see, how much extra you have in an emergency to solve if there's a problem with your debt. And what I was talking about, typically on a property, the lenders require what we call 120, or basically 20% above your debt in sort of a safety account that you have out of your yearly cash flow to use if there's other expenses on the property, there's an emergency. And in your cases, you're at 200%. So you're nowhere close to that danger zone, which is amazing. A lot of people don't have that luxury. And some people that really try and, leverage up their properties go down to like a 105 by putting, mezzanine and, sort of second and third level of debt on a property. And in 2012, that might make sense because it would give you money to buy more properties and expand that base. But it does come with a lot of risk, and you just got to be careful and prepared for that.
Cool.
Sorry, I'm doing it the wrong way again. So this is the, what lenders look at. I had a generic one, and then I have one that I've actually filled out for Jeremy and Itai. But what's important is a lender's view, they don't really just look at the property. They're looking at the sponsor, which is, you, the borrower, Itai and Jeremy. They're looking at the market. They're looking at the overall capital markets and who can refinance them out and what other options you have besides them, and then the property. So all four of those things are really critical to a lender when they make a loan. And if somebody has a credit blotch or has done something wrong in the past or had a crime, proven to be dishonest, most lenders won't do loans just because the sponsor part is really a key part of that. They find that if they have a good sponsor, even if the market turns and the property turns down, that sponsor maintains the property and keeps it going and keeps making their payments. Where you could have an amazing property, but if you have a horrible person running it that's not properly spending the money, that's not running it properly, they can destroy that good property. So it's always, people always ask me well, it's a great property, but these guys that want to buy it have never owned a property and have no net worth. There's not a lender out there that's going to lend them the money. So it takes time to build up that credibility. And we'll talk about later on Fannie Mae and Freddie Mac loans, like Jeremy and Itai did, that they want very experienced people with certain net worth and liquidity, which allow Jeremy and Itai to get, great rates and good financing.
Bryan, I saw real quick. I saw a question from Rob. Rob, do you want to share it real quick?
Yeah, a couple of things. Bryan, thank you for presenting today. Have you seen, I assume the Resolution Trust Corporation came from the savings and loan debacle, but my question is, how has forbearance affected your business? Are y'all seeing a lot of forbearances? And then if they do, what is the structure, like no payment for 3 months and then a big balloon payment at the end of 4 months? And how does that working, or what are you seeing?
Yeah, so it really depends on the property. And, when all of this started happening, a lot of owners said, I want forbearance. I think I deserve forbearance. And a lot of lenders reacted, prove to me that you need it. What we've seen first overall is credit unions have been very friendly towards forbearance. Fannie and Freddie are required by law. Also HUD is required by law. Any government associated lender was required under the CARES Act to provide forbearance for roughly 90 days. Again, you have to prove the need for it, but then they'll give you that 90-day forbearance. And typically what happens is during the second year, so sometime next year after 12 months, you'll start paying that back. And there's different programs where it can be amortized over a period of time. I guess the important thing to note is CMBS lenders have been very unwilling to cooperate. And most hotel assets in the US are financed with CMBS. So you have almost $20 billion of CMBS loans that are in trouble. And so far the lenders have been unwilling to give forbearance.
What does MBS stand for?
Commercial mortgage-backed securities. So they're basically loans that are sold to investors and to bondholders. And they're only on commercial properties, multifamily, office, industrial, hotels. And it's sort of I wouldn't call it a last resort lender, but usually it's non-recourse financing, and you get more, BC properties, and you get borrowers that maybe aren't as strong as guys that are going to a bank. So it's not always the premier borrowers that are going to CMBS, but it offers a lot of flexibility because a CMBS loan is based on yields, And so a lot of times if a property has really good cash flow, they'll do CMBS. I've done a lot of multifamily in Texas via CMBS, mainly in Houston and Dallas, where, you know, they're so-so, maybe a little bit rough neighborhoods, and the owner was able to greatly increase the value, but a bank was afraid to go into that property and give them a bunch of cash out, where CMBS acted as an option for the cash out.
What part of the country? What part of the country are you saying that your investor group's not wanting to put money into, or bank loans to?
It's interesting. I think nobody's sure about COVID yet. I mean, it's really, you know, I think the major cities have been impacted the most. You know, New York and Los Angeles. There's sort of a lot of tales of people coming out of LA and going to Phoenix or other West Coast cities and saying, you know, I want to move my companies there. I want out of LA, or I want out of New York. I don't want to be in a big city where I'm close to everybody. But as you know, I mean, now we're seeing COVID spread to Texas and to Florida and to some of these secondary markets. So I think it's too early to know the real impact. To me, and I've said it since day one, and I keep repeating it, I'm sure Jeremy and Itai are sick of hearing it, but I think that the sooner that they can solve this problem, the sooner we get back to normal. And if it's a problem that lingers for 2 or 3 years, every market in the country is going to have some impact from it. And I think, you know, like we've talked about Colleen, it didn't have a huge jump up, so it's probably not going to have a huge jump down. But if this continues for, you know, a prolonged period of time, it's going to impact, you know, Chicago and the LA and the New York, as well as the Houston and Dallas, you know, multifamily markets. Good answer.
Yeah.
Okay.
I think you did answer it. Bryan, would you be okay actually if versus going into this portion, if we, I was gonna say if we open up for Q&A, just curious how much more left you actually have on your presentation.
I'm just 2 or 3. I think I have 3 more slides, but I can.
Okay, cool. Yeah, just knock them out, and then we'll open it up to open Q&A so we can let everybody ask their questions and go.
Yeah, and if anybody has questions, I mean, interrupt me as well. I love to hear questions, so let me know. I was going to talk quickly about Fannie and Freddie, you know, the advantages of it, and sort of, you know, why people don't always use it is, you know, it's not always easy to get. They don't like first-time borrowers. You have to have an established credit record and established track record. But it is great financing. It is non-recourse, and it works really well in some situations. Basically, I'll run through this real quick, but as we look at the commercial market, it is hurting a little bit. I mean, we're seeing sales off across the country. Multifamily, I think overall has performed the best, but multifamily sales are down. The hotel market's frozen. The retail market's in bad shape. So it's just something to consider in your analysis. I mean, again, it's a lot of capital is attracted towards multifamily. The Colleen multifamily market has done well. It's done better than a lot of the other markets throughout the country. So I think there's a lot of opportunities there. And I think it's just investing smart. And multifamily is a really simple thing. People need a place to live, so they're going to need a house or an apartment. So hopefully that answers it. And I think too, if you look at, I put down below like Austin and Dallas, and it's really small, so you probably can't see it. But basically it shows that the cap rates, and if you look at a market like Colleen, it hasn't been as impacted. So where Houston and Dallas, cap rates have been going down every year, Colleen hasn't been going down as fast. So when you do these value add type of strategies, usually you don't have to worry about cap rate depreciation as you do in other markets. And that's my slides. So if anyone got a questions, that'd be great.
Yeah. Bryan, first off, thank you. And I'll make sure that we include your contact information when we send this out. But everybody, let's open it up to questions. This is a Q&A time.
Hey, Bryan. My name is Ruchi. Thanks for everything that you did. Kind of the way Itai and Jeremy mentioned about how the first deal they got was off market. And so that's, you know, one of the great ways to be able to get these deals and get some instant equity, right? And we can then bring it to a lender like yourself. But how do we create a relationship with that first point of contact with the lender, so that when a seller or owner is struggling to pay, you know, make their payments, we can already have that relationship with someone at the bank that, hey, Bryan can let, you know, Jeremy and Itai know, hey, there's something available. So this guy's struggling. I think he wants to sell. And then, you can get a deal happen, because that I feel like would be another off-market way to access those properties.
Yeah, and my answer might be self-serving, but hire me. We basically are an intermediary, so we work between a lender and the sponsor, and I think what we bring to the table, we do we do over 200 loans a year, so we have those relationships where a lot of times our clients might do 1 or 2 loans with them, but we might do 30 loans with the same lender. So we have those type of relationships. So instead of going out and getting up to where you're buying 20 properties a year, you hire somebody like me that works for a company that has those relationships and is in the market every day. And we it's one of the advantages we give to people is we bring those relationships to you, where we, introduce you to the top people at the lenders. It's with Fannie and Freddie on their deals. And I hope you guys don't mind me disclosing this, but one of the properties they worked on was a smaller property, and Freddie Mac, for whatever, the inside analyst at Freddie just did not want to do this loan. He thought it was too small. He thought the market was too small, and he kept raising these obstacles. And we decided there just wasn't any way we were going to let him not do the property. And, he would come up with a reason, and we would get back to him with why they needed to do it. And, just through persistence and pushing him, he finally agreed to close the loan. It took, a couple weeks longer, but it's a relationship business. Like, those guys know that they're going to see me next week, 2 weeks, 3 weeks. And there's very few owners out there that are in the market as much as we are. And even
Bryan, remember that was during COVID too. So yeah, that was in the heart of COVID, and nobody wanted to lend, and you still made it happen.
Made it happen.
No, and you guys asked about, or you asked about defeasance earlier. It was interesting, the Freddie Mac lender we worked with had a client that had done 133 Freddie Mac loans and was worth over $500 million. And he asked for defeasance because the law said you could have defeasance on your properties. So he did defeasance on 72 properties, and he was in application for a new loan, and Freddie Mac turned him down because they thought, well, you need to do defeasance on these other properties. You obviously don't have enough capital, so we're not doing a new loan with you. So it's not supposed to work that way. It's not supposed to penalize you for doing defeasance, but unfortunately, some of the lenders still do that.
Okay, cool. Thank you.
Any other questions?
That could be to any of us, not just Bryan. Anything we talked about tonight.
Sure, I've got a question, and it's to all three of you really. So using this BRRR, I don't know if I did enough R's model.
BRRR. Think
BRRR.
Chicago wintertime. BRRR.
Awesome. Using the BRRRR model. The only thing that would make me uncomfortable is at some point you have so much leverage that you really do have market sensitivity. If you have a downturn in the marketplace, in the general real estate market, you've got a problem. So I'm wondering whether you have any plans, and Bryan, whether you've got clients with larger portfolios that do any risk management, whether it's with somebody like Blackstone or using Case-Shiller or futures or things like that. Are there ways that you implement risk management for the full portfolio?
Well, if I answer it for us, the answer is pretty simple. We just don't over leverage, right? So we have basically the debt service ratio, right? So I make sure that even if the market turns down and prices quote unquote turn down and cap rates go up, I just make sure that I know that the available income that comes in is at least 2 times what we need to cover the debt service. So even if the market takes a general downturn, we know in our area that hasn't necessarily affected anything really. And in the last 2 months, we've had 100% rent collection. So that kind of proves it during COVID. So I think as long as we don't over leverage and just use leverage in a smart way and keep enough of a buffer between how much debt we're accumulating and how much our income is to pay for that debt, we should be fine.
And Itai, a follow-up question is, when you all refinance, what are you all thinking as far as time frame? Y'all gonna go 30-year, 10-year? What are y'all gonna be doing?
Well, we do a 30-year amortization, but I think the longest we can go is a 10-year term because it is a commercial kind of loan, unless Brian has a better option for us.
Yeah, typically with Fannie and Freddie, you're going to be limited to 10 years. At least that's usually the best deal. You can sometimes do 15 years in set circumstances. And there's insurance companies that will do, super low leverage, 15 or even 20 years. But usually the most optimal loan for commercial owner is, a 10-year loan.
Is that a balloon loan or is that a regular, almost like a conventional type loan?
It usually balloons. Some of the Fannie and Freddie products are actually like a 7-3, so they'll be fixed for 7, and then you almost have like a 3-year refinance period, and then it balloons at the end, but it gives you more time to refi. There's different ways of structuring it. Like on one of their deals we talked about where we were substituting, a perm loan in for a bridge loan, we actually did a 10-year balloon loan, but it was typically a scenario we'd more or less do a 1 to 3 year bridge loan because they're improving the property. But we gave them that extra safety. If the market in 3 years isn't in good shape, they have 7 more years to fix it up. And going back to the other question too, I think that's how you really protect yourself with real estate is like Itai said, is not having a lot of leverage, but then also time usually cures everything. And if you can hold on to a property for long enough time, I mean, people that had properties in 2008, those properties are worth much more today than they were in 2008. But they had to survive 2009, 10, and 11, and probably half the owners didn't have that staying power to make it through those 3 years. So it's really about power and timing to stay through those periods.
Sense.
Cool. All right. Well, everybody, we've held you hostage long enough. We appreciate you all signing on. Brian, you are the man for doing this. Thank you. Thank you so much. We appreciate it. And what we do is we normally just kind of hang out for 10 minutes now informally, just kind of talking about whatever people want to talk about. This is kind of our chill time. So anybody that wants to sign off, you are free to go. Thank you for coming in. This is something that we do. We do multifamily investing. And if that's something that interests you, give us a shout because we are buying a lot of other stuff. And in the meantime, we're just going to hang out and just have a good time. So thank you all.